Well, good morning, everyone. I'd like to call this the first meeting of the Joint Economic Committee for the 113th session of Congress to order. The Employment Act of 1946 established the Joint Economic Committee to analyze economic issues and make policy recommendations to Congress. And as the 37th chairman of the committee, I want to congratulate Senator Amy Klobuchar on becoming vice chair and welcome both new and returning members to the committee. I would like to introduce our new members: Representative Eric Paulson of Minnesota, Representative Richard Hanna of New York, Senator Roger Wicker of Mississippi, Senator Christopher Murphy of Connecticut, Senator Martin Heinrich of New Mexico, and Representative John Delaney of Maryland. While the United States confronts many problems, our most vexing economic challenge is the growth gap and how we close it. The growth gap between this economic recovery and other recoveries is significant and intensifies our federal spending and debt problems. The growth gap has two interrelated aspects. First, by objective economic measures, the recovery that began in June 2009 remains the weakest among recoveries since World War II. Second, according to many economists, our economy's potential to grow over time has slowed. If true, the average rate of growth and private job creation during this recovery of 2.1% annually and 175,000 new jobs per month, respectively, are about as good as our economy will ever perform in the future, and that is unacceptable. Therefore, it's appropriate the first hearing of the committee should address this growth gap. Why have economic growth and job creation remained weak, and what should Congress do to boost them? The anemic nature of the current recovery is indisputable. During the current recovery, real GDP increased by 7.5% in 3.5 years. By contrast, average real GDP growth during the same period in all the post-war recoveries was 17.5%. Today's recovery is less than half as strong as the average. Real GDP would have to grow at an annual rate of 5.5% in each of the next 4 years merely to catch up with an average recovery by the end of President Obama's second term. That would be slightly higher than the 5.4% annual rate that President Reagan achieved during the first 3.5 years of the Reagan recovery. Private payroll employment, that is jobs along Main Street, have increased by only 5.7% since its cycle low. Had this recovery been merely average, private payroll employment would have increased by 9.4%. The growth gap means the United States should have 3.9 million more private jobs today than it does. Equally troubling is mounting evidence that the annual growth rate for potential real GDP in the future has fallen dramatically. In its most recent budget and economic outlook, the Congressional Budget Office cut its estimate of the potential real GDP growth rate to 2.3%. 1 percentage point below its average since 1950. 1 percentage point may not sound like much. However, the real economy doubles in 22 years at 3.3% growth rate. But at that lower, smaller rate, it takes 31.9 years to double, almost a decade longer. The prospect of a new normal for America's economy, in which our future economic growth permanently slows by 1/3, should be a red flag for all Americans. During this Congress, the committee will, through hearings and research, investigate the growth gap and how to close it. No doubt some of the growth gap may be due to demographic factors that are not so easily amenable to economic policy. However, even a cursory review of recent history strongly suggests that economic and fiscal policies have played the dominant role. To understand how these policies affect performance, let us compare the generally pro-growth policies and the superior performance of the U.S. economy during the 1980s and 1990s with the generally slow growth policies and the lackluster performance during the last decade. During the Great Moderation, under both Republican and Democratic presidents and Congresses with Republican, Democrat, and split control, the federal government generally pursued pro-growth economic policies and achieved outstanding results. The size of the federal government, as measured by federal spending, gradually shrank relative to the size of the economy. Marginal income tax rates fell. Policymakers focused on reducing the after-tax cost of capital for new business investment, and jobs grew. monetary policy became increasingly rules-based and predictable. Ignoring the employment half of its dual mandate, the Federal Reserve focused on price stability. The regulatory burden on businesses and households declined, and the United States led the world in liberalizing international trade and investment. Beginning in 2001, under both Republican and Democratic presidents and Congresses with Republican, Democrat, and split control, the federal government reversed course, in large part due to the terrorist attacks of 9/11, and the results have been disappointing. The size of the federal government has grown substantially relative to the size of the economy, soaring to 25.2% of GDP and remaining elevated at an estimated 22.2% of GDP during the current fiscal year. Marginal income tax rates were first decreased, then increased. In recent years, policymakers have primarily focused on the fairness of the tax system instead of its effect on growth. Monetary policy has become discretionary once again. The Federal Reserve has justified its extraordinary actions based upon the employment half of its dual mandate. The regulatory burdens on businesses and households has increased, generating uncertainty and inhibiting new business investment. The United States has fallen behind its major trading partners in liberalizing international trade and investment. Today is the perfect time to focus on the growth gap and what we should do about it. Given the historical and legal relationship between the Joint Economic Committee and the Council of Economic Advisors, it's appropriate that two of the most distinguished former chairmen, Dr. Michael Baskin and Dr. Austin Goolsbee, are with us today as witnesses. With that, I look forward to their testimony. I recognize Vice Chairman Klobuchar for her comments.
Well, thank you very much, Chairman Brady. It's an honor to be here in my first meeting as the Vice Chair of the Joint Economic Committee and joined by many great colleagues from both the House and the Senate. I look forward to working as a committee on some very good discussions and hopefully solutions to the budget and the economic problems facing our country. I also want to thank our two witnesses, Dr. Baskin and Dr. Goolsbee. It is a great way to start this hearing with both of you having been former chairman of the Council of Economic Advisors. We're gathered here at a time, as we know, when Congress's energy is focused on sequestration and the solutions to that. While that is not the focus of today's hearings, in many ways it's a good starting point for our discussion, not just because of its economic consequences, but because it underscores the critical need for thoughtful, balanced, bipartisan policies that address our debt challenges without undermining growth. My hope for today is that we can explore some of the bigger picture's ideas for moving our economy forward while discussing specific policies for strengthening the fundamentals, the core economic engines like entrepreneurship and innovation. As we examine the current economic landscape, I think it's important to remember where we were just a few years ago. I sat through many hearings in this very room as we would hear the unemployment numbers, as we would hear from economists of the difficult situation our country was in. I think back to the first half of 2009 when our country was losing jobs at a rate of nearly 700,000 a month. That is literally equal to the entire population of Vermont. 4 years later, we're adding jobs. Not as many as we'd like, but we've still seen 35 straight months of private sector job growth. In that time, more than 6 million private sector jobs have been created. We've also seen promising signs of growth recently in critical industries like housing. Take the January numbers for new home sales. They hit their highest rate in 4.5 years, up nearly 16% compared to December. Exporting has been another bright spot, with the total value of American exports reaching a record of $2.2 trillion last year. I personally spent last week in 30 below wind chill weather around Minnesota, visiting 30 different businesses, saw warehouses full of big crates that said shipped to China, and saw firsthand in our state, where we're down to 5.5% unemployment, what we are seeing with this kind of private sector job growth, which is based so much on exports in our state, as well as a skilled workforce. These are positive signs, but it's clear that there is so much more to be done. There are still more than 12 million Americans out of work, and there's no question that we have much more work to do. Our focus needs to be on policies that spark job creation in the short term while laying the groundwork for prosperity in the long term. Because if we've learned anything from the economic turmoil of the last few years, it's that America can no longer just afford to be a country that churns money. Our financial industry is important, but it cannot be the basis of our economy. We need to be a country that makes stuff, that invents things, that exports to the world. We need to be working to bring our country back to those brass tacks of innovation and entrepreneurship. I again mentioned that I come from a state. I will try not, Chairman Brady, to mention my state too much, if you don't mention Texas too much. But my state brought the world everything from the pacemaker to the Post-it note. We're second per capita for Fortune 500 companies. So I have a model that I look at when I look at how we were able to keep our head above water during this downturn. And the model is really about innovation and exports. But this just isn't a Minnesota story, it's an American story. I believe that innovation is the engine that has kept our country moving forward since its earlier days. So the things that I think we need to focus on with this committee as we go forward and working with Chairman Brady, and I hope we can be as bipartisan as possible. We're going to have different views, but as long as we get the right information from our witnesses, I think we can come together on a number of hearings. First of all, our debt. We need to bring our debt down in a balanced way. I personally think that there were some very good things coming out of the Simpson-Bowles Commission and the work that's being done by many on that balanced approach to bringing the debt down. I don't think we can put our heads in the sand, and certainly not when we're facing sequestration. Secondly, education. I think we should double our number of STEM schools. I think there's so much more that we can do to get our kids to get into science, engineering, technology, and math with a better focus on these two-year degrees. We have so many companies right now in our state that are looking for welders and tool and die, and these are jobs that are there right now that are going unfilled because we have failed to train students in those areas where we have jobs that are good-paying jobs. Exports, I mentioned, the President's goal of doubling the number of exports within this 5-year period is attainable. Regulations, looking at keeping very important safety regulations in place, but going industry by industry and saying, what can we do to make things work better so we can compete on an international basis? Reforming our tax code so it provides greater clarity and consistency, and doing something about immigration reform, which I think is very doable given the bipartisan work that's going on in the United States Senate. I'm excited about the coming year on the Joint Economic Committee and working with Chairman Brady and the rest of my colleagues. I look forward to this hearing. Thank you very much, Mr. Chairman.
Great. Thank you, Vice Chairman. At this time, I'd like to welcome and introduce our distinguished witnesses for today's hearing. Dr. Michael Baskin is a senior fellow at the Hoover Institution and the T.M. Friedman Professor of Economics at Stanford. Previously, Dr. Baskin served as chairman of the President's Council of Economic Advisors from 1989 to 1993, at which point the Independent Council for Excellence in Government rated the CEA as one of the 5 most respected agencies in the federal government. Also, Dr. Baskin chaired the highly influential Blue Ribbon Commission on Consumer Price Index, whose report has transformed the way government statistical agencies around the world measure inflation, GDP, and productivity. Dr. Baskin is author of more than 150 books and articles, is internationally recognized for his research, and has received the Adam Smith Prize for outstanding contributions to economics in 1998. Dr. Baskin received his bachelor's, master's, and PhD at California, Berkeley. Next, I'd like to introduce Honorable Austin Goolsbee. He is currently the Robert P. Gwynn Professor of Economics at the University of Chicago, the Booth School of Business. Previously, he served on the Council of Economic Advisors from 2009 to 2011 and led it as chairman from September 2010 to August 2011. He writes monthly for the Wall Street Journal and is a contributor and respected economic analyst for ABC News. Dr. Goolsbee has also spent time as a special consultant for Internet policy for the Antitrust Division of the Department of Justice and was the lead editor for the Journal of Law and Economics for several years. Dr. Goolsbee earned his bachelor's and master's degrees in economics from Yale University and graduated with a doctorate in economics from the Massachusetts Institute of Technology. Well, clearly we have a highly respected witnesses who we hope will bring insight in reading the testimony previously to this. There is an awful lot of wisdom to be tapped today as we look at these issues. So Professor Baskin, Professor Goolsbee, thank you for your willingness to come before the committee. We look forward to hearing your testimony and expert opinion. Dr. Baskin, you're recognized for 5 minutes for your statement.
Thank you, Chairman
There you go.
Brady, Vice Chair Klobuchar, distinguished members of the committee. I've had the privilege of testifying before this committee and working with it since the late 1970s, when Senator Benson, in a remarkable bipartisan effort, got 19 of the 20 members to bring the supply side of the economy to the attention of Congress and the concerns there, in addition to the demand side. I obviously testified often in my 4 years as Bush Senior CEA chairman when we were cleaning up 2 financial crises, the savings and loans and the money center banks being insolvent. We had the first Iraq War, a oil shock, and a recession, so not totally dissimilar, although not as large a scale as what we went through recently. Obviously, we had a horrific recession following the collapse of the housing market and the bursting of the housing bubble and the financial crisis. The recovery, unfortunately, has been anemic. Compared to previous recoveries from deep recessions, its GDP is growing at about 40% as rapidly, and employment only 20% as rapidly. This long period of subpar growth is as damaging to lost incomes and employment opportunities and skills as the shorter, however deep and severe recession. The modestly good news is, despite the fact the economy's basically been flat lately, and most people expect this quarter to be only slightly positive, most forecasters expect the economy to pick up a little later this year and into next. The administration's particularly at the high end of that forecast, as it has been for some time. Hopefully they're right, but the blue chip is looking at 2.5% or a little higher growth this year, heading to 3% next. That would still be way below what the economy should be doing recovering from such a deep recession. There are many, many risks the economy faces, from problems in Europe to fiscal instability to geopolitical issues, Iranian oil, for example, continued deleveraging of the private sector, additional regulation raising costs and uncertainty that is yet to be written and enforced, and so on. All of those, and the uncertainty about the Fed's exit from its monetary policy. But there are a few good signs. The fiscal drag at state and local governments from their tax hikes and spending cuts has probably peaked. The technology revolution in fracking is bringing energy costs down in the United States and is promoting jobs along a wide array of our states. Housing seems to be rebounding, and there's lots of cash sitting on the sidelines in household and corporate balance sheets waiting for an improved economic environment and an improved policy environment. I believe that the early policies, the early Fed actions, the automatic stabilizers in the tax code, and the making capital available to the banks, as poorly as it was done, was essential to preventing the recession from being even worse. But much of the policy since then has not been nearly as effective as it could have been. I detail that in my testimony, but in my own view, the temporary spending increases, inframarginal tax cuts, the attempted social re-engineering of the economy in wide swaths from energy to health care to financial services, whatever their intrinsic benefits and costs were, created a lot of uncertainty, delayed investment and hiring. So I think there's lots of reasons to believe that we have a different course of action is likely required now. In my opinion, it starts with a strong, credible commitment to serious fiscal consolidation, phased in gradually as the economy recovers, difficult to reverse absent a major emergency such as war or recession. That means it's got to be permanent and structural. It likely requires toughened budget process rules on spending and debt. Pro-growth tax reform, lower rates on a broader base, which almost all economists agree is desirable, would be an important complement to that effort. In the long run, we need to get entitlement cost growth under control in a manner that strengthens and preserves our key entitlement programs, but prevents them from bankrupting the rest of the private economy and the rest of the government. We're simply put, we're going to have too many people collecting too generous of benefits, not that they're all that generous at the bottom, but we should be trimming them at the top, and we should be slowing their real increase per beneficiary through a variety of structural matters. I've calculated that the harm from allowing the projected debt to grow. We hear it's unsustainable. That's too antiseptic a term. It's dangerous. It really would lead, by all the basic studies that have been done of this, to a generation of lost income for our children and grandchildren on the order of 20 to 30% lower than it might have been. So we need to get the debt GDP curve heading down in the near future as the economy recovers and continuously. I think that there should be, therefore, in addition to those two things, medium-term fiscal consolidation and tax reform, long-run entitlement reforms that minimize work and saving disincentives while reducing subsidies to the well-off, budget reform making programs more effective. Vice Chair Klobuchar pointed to some of these issues about jobs going vacant for lack of training. We have 46 job training programs in the federal government. President Obama added another one for green energy jobs. It didn't work very well. The Labor Department Inspector General said it should be shut down. Most of those programs don't even have metrics. We need to take those 46 programs, eliminate the bad ones, consolidate the hopeful ones, modernize them, and get people jobs. That's something Republicans and Democrats should agree to. It's conservative and liberal. It will help people at lower cost. There are many examples of that throughout the government. I'd be happy to take questions on that. And in terms of monetary and fiscal policy, it needs to be far more predictable and permanent, and basically I call it rules-based. Even if it's not following a specific clear rule, it's working as if it is. There's obviously, any time it deviates from it, it's clearly, there's clearly an emergency reason, and so on. You could start by eliminating the endless use of temporary tax rules and new spending programs that leaves everybody uncertain about whether they'll be renewed, that jerry-rigs all the incentives in the economy. Of course, in addition to that, the human capital policies, education, as well as job training reform, sensible regulatory reform, and I might add trade liberalization, which I'm glad to see the President has begun starting to talk about in some dimensions, would be important complements to this, but the focus should be on medium-term fiscal consolidation, primarily on the spending side, as the economy recovers. The research shows successful fiscal consolidations that do not cause recessions and succeed in consolidating the budget have $5 or $6 of spending cuts for every dollar of tax increase. So a balanced, an economically balanced fiscal consolidation is primarily on the spending side. It's not 50-50. Thank you. I wish the committee tremendous good luck and progress under the new chair and vice chair, and I look forward to working with you and to hearing your questions.
Great. Thank you, Dr. Baskin. Dr. Goolsbee?
Thank you, Chairman Brady and Vice Chair Klobuchar. It's a great honor, and I appreciate the invitation. I think the central question that you have raised here today fits in the tradition of the Joint Economic Committee, where they've had a long history of Democrats and Republicans working together, the House and the Senate working together. And I think there are a lot of things that Dr. Baskin and I can agree on, not the least of which is our dress code today. We did not coordinate, but if the questioning gets difficult, I'm simply going to try to look like I were him and maybe direct the questions away from myself. The central question is, why is the economy not growing faster after a deep recession? Now, and I think there are three primary reasons for that, but before I state those reasons, I would just like to make one factual observation, which is this is not the weakest recovery in recent memory. This is not even the weakest recovery of the last two recoveries. The 2001 recovery was substantially slower than this one. What is different about this one is that it is not V-shaped in the way, as Professor Baskin points out in his testimony, it was after the deep recessions of 1975 and 1982. And I think there are three reasons why that is. The first is this recession came from the popping of a bubble, unlike the 1982 and 1975 recessions, and popping bubbles are much more difficult to escape from the grips of than are the others. So in 1982, my dear friend and mentor Paul Volcker the interest rates rose to over 20% on mortgages. Economic activity slowed dramatically. As interest rates came down, that pent-up demand could come right back. The fundamental necessity for a V-shaped recovery is not having to do a lot of structural transformation of what the economy is doing, but being able to go back to what you were doing before. there was a joke headline in the Onion newspaper. Furious nation demands new bubble to invest in to restore prosperity. Let us not try to reenact that Onion headline. So it is quite clear in looking at the data, as we highlighted in the 2011 economic report of the president when I was serving as the chair, that the expansion of the 2000s was dramatically outsized in its contribution of housing construction and personal consumer spending as the key drivers of growth. It was way underweighted compared to past recoveries and expansions in the U.S. and compared to other expansions around the world in business investment and export growth. We must shift the economy away. We cannot go back to the building of residential construction and personal consumption spending faster than income growth as the two drivers of growth. Those were fueled by a bubble, and they aren't coming back in the way that they were then. So that has taken some time. As to what that means for the job market, I think it's not a secret that the reason the performance of the job market is tied to how much faster growth is than productivity. Productivity of our workers grows about 2% a year. So anytime growth gets above 2% in the economy, you have to hire workers or add hours to meet that kind of demand. And if growth remains in the 2% range or below, the job market is going to remain relatively stagnant. Now, as Professor Baskin said, the good news is that the forecasts are that growth would get back up in the 2.5% or higher range in the immediate term. I fear that the impact of the sequester would cut 0.5 to 1 percentage point off the growth rate, and that it would again put us back into the circumstance in which growth is not fast enough to shrink the unemployment rate, that instead of unemployment shrinking, unemployment would be rising again. I think the second factor that has made this not a V-shaped recovery is that we're overcoming the worst housing market in U.S. history. If you look at the research of Ed Leamer or others, housing and construction are the most cyclical component of the economy. They have a much outsized importance in accounting for the short-run business cycle. So the normal coming out of a recession is at least a third related to new construction. We got overbuilt in the bubble with 6 million vacant homes. Construction fell close to nothing. It's quite understandable why the overall growth rate of the economy has not come back in the short run as rapidly as in past big recessions, because we couldn't go back to getting anything from construction. The good news is that the long nightmare of housing in many, if not most markets, appears to have turned the corner. So we may start to get some contribution from that. Third, the evidence is that financial crises and big deleveraging take a major toll on growth. The economic report of the president from this year compares the U.S. experience in its labor market to the experience in other countries that have had major financial crises, and actually the U.S. appears to be doing a fair bit better than average for that circumstance. Now, all of those are just to say it's not fast enough, but I think it is understandable why it wasn't V-shaped, why it looks more like the 2001 recovery than it does the 1984 recovery. Lastly, I would like to say two things that I believe the data do not suggest are predominantly to explain why growth has not been faster. The first is, I do not believe the data supports the view that regulation or policy changes over the last 3 years are the predominant reason why growth has not been V-shaped recovery. If you look at things like the accumulation of money on the balance sheet of corporations and a lack of willingness to invest, that pervades all the advanced economies of the world. That is happening in countries that did not pass a health plan, that have not had any changes of their regulatory regime. And so anybody who is arguing that that regulation is the driver has to explain why the pattern is consistent across these other countries. Second, the way economists normally measure the impact of regulation on growth, when they say, for example, that the 1977 Clean Air Act affected manufacturing, they compare counties where it applies strictly to counties where it doesn't. They compare those industries and companies that are affected to those that are not, by size, by sector, et cetera. If you do that now, there is little evidence that those regulatory policies are the primary driver. The second factor that I believe the evidence does not suggest is the cause is the short-run deficit. Most of the short-run deficit has been caused by the downturn, not caused the downturn. And while I 100% agree and have for a long time been an advocate of a rational, long-term fiscal consolidation, I think you need only look at the GDP evidence in the United States in the fourth quarter or in Europe, where they are engaged in dramatic austerity, to realize that there is a tension between trying to cut too much in the immediate term and the growth rate. I think the normal channels by which fiscal contractions can be expansionary go through the interest rate, that you satisfy investors, make them more confident in the plan, so the long-run interest rate comes down. We are facing epically low interest rates. We have bumped against the zero lower bound multiple times. It is hard for me to understand the mechanism by which fiscal contractions would be expansionary in this environment. I believe that there are many things that we can agree on, whether on long-run fiscal consolidation, on investing in training and innovation as the keys to growth. I hope we do not do something that would be a mistake in the short run on a purpose that is something other than reestablishing a growth strategy. Thank you.
Thank you, Dr. Goolsbee. Thank you both for the testimony. Dr. Baskin, as we look at the growth gap, ways to close it, risks to our economy, and more importantly, solutions, you mentioned just recently the generational damage by this high spending to GDP ratio, and about the need for fiscal consolidation. Economists generally believe that federal spending should be capped relative and controlled relative to the size of the economy. The challenge is how best to do that. I'd like your advice. We've developed over the past year and a half legislation called the MAP Act that addresses spending caps. And the difference from past efforts is that we use two slightly different, we think, smarter metrics to do that. One is the numerator is a non-interest spending, that which is controlled by Congress, both discretionary and entitlement type spending. And the goal clearly there is to be able to gradually reduce what we can reduce without adding pressure on us to, push the Fed to keep interest rates, politically low to mask that debt. The second, the denominator, is potential GDP rather than estimated actual or a rolling average. And the thought being it's not as cyclical. Congresses can't spend as much in the good times, nor do they have to cut quite as much in the bad times. As we go forward, trying to find bipartisan solutions on fiscal consolidation, on gradually lowering the size of our government relative to the economy, are those metrics good ones to work off of?
I think you're headed. I think you're definitely headed in the right direction, Mr. Brady. I think that it's important that we allow the automatic stabilizers, for example, to work. I mentioned them. Austin dwelled on them as the major cause. I agree that quantitatively they're a large part of the deficit. Second, so that's important. I do believe there are two other things that are worth considering. One is that for good purposes or other, we often wind up doing things that are like spending but don't count as spending. We regulate. When the government says, put this on your car, and therefore the auto companies do it and they charge people higher prices for their car, that may even have a good benefit cost ratio, but it doesn't show up as part of taxes and spending. It's almost the same thing as the government spending the money, taxing and spending the money and installing it. So regulation's a substitute, and tax expenditures, of course, are a substitute for spending. So you would need to have some complementary way, legislation or some safety valve to prevent that you could tighten if all of a sudden the spending cap started to bind and it started edging into regulation and tax expenditures. The other is when you look at spending, there's this fundamental fact of arithmetic we can't get around, that the present discounted value of future taxes has to equal the present discounted value of future spending plus the national debt. The government has to pay its bills now or later. $1 borrowing now means $1 plus the rate of interest tomorrow has to be raised to pay off the interest. So with that in mind, it's very, very important that the spending caps be reasonable and bind, and that there's some mechanism by which we don't, even with reasonable spending caps, start continuing to accumulate more debt as well. So there's an issue whether you need something on the deficit and debt side simultaneously with spending. Spending minus taxes equals the surplus or deficit. So you need really to do two to control to control three. But I think you're at the fundamental core. The first thing we need to get under control is spending. We can argue, I think we would both agree that that should be done gradually as the economy recovers in the short run. But in the long run, these projections, even if you shave them for optimistic assumptions, are really, really tremendously harmful. To take the path of spending, as I indicated in my testimony, as the OMB projects for the president's policies, with reasonable assumptions, and adding, which includes the future projected growth of Medicare and Social Security, means that we're going to have a wide swath of the population paying marginal tax rates of 70% when we keep paying for it with higher payroll and income taxes, not just the very well off. And it's hard to imagine in a generation from now that we can have a successful, dynamic, growing economy with a large fraction of Americans being a minority partner in their own labor. So I think that you're really right that spending is the fundamental thing. The other thing I might say is you want to give some thought to the very long run about whether you'd have a recalibration exercise or think about how demographics interact with it.
Got it.
But
Right.
you're basically in the right place.
Thank you, Dr. Baskin. Vice Chairman?
Thank you very much, Mr. Chairman. Thank you both. I did see a few common threads in your testimony, and I just want to start with the elephant in the room and go through a few questions a little more quickly. On Tuesday, Federal Reserve Chairman Ben Bernanke testified before the Senate Banking Committee, and he said, and this is a quote, "The Congress and the administration should consider replacing the sharp front-loaded spending cuts required by the sequestration with policies that reduce the federal deficit more gradually in the near term, but more substantially in the longer run. Such an approach could lessen the near-term fiscal headwinds facing the recovery while more effectively addressing the longer-term imbalances in the federal budget." I'll start with you, Mr. Goolsbee. Do you agree with his statement?
Yes.
Very good. Dr. Baskin, if you could keep your statement shorter, I noticed that you talked about a phased-in reduction. Do you think that there's a better way to do this than the sequestration?
I think there's a better way, but I do want to make sure we understand that this year, the total effect on outlays is going to be between 40 and 45 billion because the budget authority gets spent over a couple of years. That's 1/4% of GDP. So it's very hard to believe that this year the sequester would be a major macroeconomic event. What other specific dislocations it had for some programs and people. Next year it starts adding up. So it would be better to have it shaped like this, there's no doubt. But it's very, very difficult to credibly do that when we're living in a world where every 2 months we've got a new set of negotiations about what's going to be.
Agree.
So
I think there's
a big
many up
trade-off.
here that would have liked to do a bigger thing at the end of the year, but we will proceed now and have those opportunities in the next few months. And there's many, I know in the Senate and I know in the House that want to get this done. I wanted to just follow up on one thing you talked about, Dr. Goolsbee, that I thought was interesting, and that is the number of businesses that have accumulated money right now that we would like them to invest in our country. And part of it is the problems what Dr. Boskin's been getting at with the uncertainty, with changes all the time. And you, I thought, rightly noted this is not just our country that has this problem. What I wanted to get at is how you think we can unleash this money and get it invested.
Well, in my view, the reason it's accumulating in the U.S. and in other countries is fear about the world economy has a recovery taken hold. For all of the discussion of our growth rate being modest, at 2.5%, that's about the fastest of all the advanced economies in the world. which is a sad state of affairs. It's been a tough period. So I think uncertainty about overall world economic growth, and second, fear over whether there will be another major financial crisis led by problems coming out of the European banking sector. I think those two things hang over the investment decisions of big firms, and really we can only address that part through macroeconomic management and trying to persuade the Europeans to confront their problems. I think on the micro policy side, investment tax incentives, I think, do have some impact in an environment like this on the decision of if you're going to invest, where do you want to invest? I think putting a focus on, in some of the sectors, getting skilled workers and trained workers that are, in our language, complementary to the capital is quite important, because you've seen in some high-tech manufacturing and in others, they haven't been able to do that. And the third, I think there is a confidence element that as growth gets going, you will see more pressure like what you've seen with Apple and others, that investors go to the firms and say, either use the money for investment or pay out the money, and we will use it for investment, but don't just sit on the money.
Okay. I wanted to follow up on one thing you raised, the workforce issue. I was picturing myself telling these small business owners in Minnesota, you need some workers that are complementary to your capital. I'm not sure that would quite work, but I think it's right on in terms of trying to encourage our schools from the high school level on to train workers. And I think manufacturing is one of our big bright spots right now, but we simply don't have enough people going into welding and tool and die, and we need more women doing it because we simply need more people doing it. And we're in big effort in Minnesota to recruit more women into manufacturing for the floor because of these job openings. And if you could just briefly, in just a minute here, Dr. Goolsbee, talk about your views on this, and maybe in a second round I'll ask Dr. Baskin about your ideas with consolidation.
I absolutely agree with that statement, both of those statements, that manufacturing has been one of the bright spots. It's pretty clear, as I said in my testimony, if you look at the data, the U.S. has got to shift a more export-oriented growth model, and that the biggest export market for the U.S. is in the manufacturing sector. Most of what we export are manufactured goods. In those cases, there are, and especially in a state like Minnesota where the unemployment rate has gotten as low as it has, those issues of finding structural mismatch and addressing it are quite important. And it behooves us now at a time when I still think cyclical unemployment is the dominant factor nationwide, but very soon, as the unemployment rate comes down, structural unemployment will be what remains. And we've already seen the weakest parts of the job market being the dropouts of the labor force and a group of people that have been unemployed for a very long period. That these issues of training and skill are going to be forefront issues. Oh. The thought that we're going to cut into investments like that, I think, is short-sighted.
Okay, thank you very much, both.
Thank you. Representative Hanna?
You touched on long-term structural unemployment. As regards Michael Spence's work, that'll clarify for you quickly where I'm going. We have created, in the past 20 years, the vast majority of jobs have been service jobs. A very small percentage have been science, technology, engineering, and math. We know that we have income disparities that are growing, and that we also know that every job is not the same. We could have zero unemployment and still people could be struggling paying their bills. What do you think is the severity of our, in a global sense, that we are increasingly moving away from those things we need to invest in to increase our global competitiveness in terms of innovation, tradable goods, and that type of thing. How big a factor do you think the unemployment rate that we are seeing right now that seems to be so intractable is a function of us not being as competitive and as skilled as we need to be as a people? For both of you.
Yeah, sure. Well, I think it's a substantial part of our problem. It's both a short-term problem and a long-term problem. I think people aren't getting jobs now. American firms list 3.5 million job vacancies, saying they don't have workers applying with the skills they need. They're not all computer programmers, as Vice Chair Klobuchar mentioned, welders, tool die people, et cetera. That's partly a problem of our K through 12 education system, and partly a problem of the opportunities, private and governmental, to retrain yourself when you need to retrain. As I mentioned earlier, we need to modernize these job training programs. Austin used the phrase, hate to see us cut investments in that. Well, I think we could get a lot better out of it for less money and actually help people a lot more than we do now. So I think that spending shouldn't be the metric. The metric ought to be how many people get jobs at the end. So I think it's a serious problem. I think in the long term, it's a larger problem. As Austin said, there's still sizable cyclical unemployment, but as that comes down, hopefully in the next 2 or 3 years to closer to full employment, what remains will be primarily structural. I also think there's a tendency in many firms when they're hit with really rapid, sharp adjustments that they make deeper cuts, including stuff that's accumulated they haven't gotten around to, with all due respect. And therefore, they tend to shed a lot. In recent times, they've shed a lot of labor more than they might have in previous downturns for the same cyclical component, and they've pushed their remaining workers to retool and train and become more productive. So I think all that's interactive. I think there's something major to it.
I think it's a major issue. I don't think that I think it's not appreciated that the U.S.'s competitiveness problem has not principally been on the productivity side or the quality of our workforce. We remain, really, of all the major economies, the most productive workforce in the world. And we only got more productive during this recession. So I think the long-run competitiveness of the U.S. economy is pretty strong. I think we've gone through a heavy cyclical unemployment period, and I think what Professor Spence has highlighted, and it is something that we all ought to think about, is there are a lot of different sectors and different jobs that in some sense have never faced foreign competition that have become tradable goods. And that leads to a lot of tough adjustments, and we will have to, and we should make quality investments. I think Professor Baskin's point is well taken, that let's do what those things that will get people jobs and sustain them in the jobs. The advance of technology, however, let's not overly dreadfulize it, if that's a word. If they had said in 1920 how many phone lines would exist today, they would have said that's flat out impossible because every man, woman, and child in America would need to be a telephone operator. The fact that they don't need to be telephone operators didn't put everyone out of a job. Gradually, as we trained for other things, we got more skill. We just shifted into other sectors greatly to our benefit and greatly to our income. And there's no reason we couldn't do that again.
Thank you.
Thank you. Representative Cummings?
Thank you very much. It's good to see both of you today. Dr. Goolsbee, in your testimony today, you suggest that Congress could help the housing market recovery by, and you said, facilitating refinancing for people unable to take advantage of low rates because they're underwater, and by facilitating people to convert vacant homes into rental properties. And I found it interesting what you said about housing. I think housing sometimes has been put on the back burner, and for my constituents, it's a big deal because they have lost a lot of wealth with the recession. Could you explain the actual benefits to the economy of allowing borrowers to refinance their mortgages down to these historic low interest rates?
Yeah, you bet. And look, in the city of Chicago, where I live, the impact of the housing downturn has been really devastating in a lot of cities in the United States, as well as a lot of suburban areas. This has weighed on growth in a quite substantial way. The benefit of refinancing is pretty simple. As Professor Baskin discussed in the case of taxes, the most effective tax cuts are those that are long-lived and permanent changes to people's income. We've got epically low rates, but if you're underwater in your mortgage, you can't go refinance at the bank. So you're paying an interest rate that's well above what the market rates are. And this has been noted by Chairman Bernanke as an impediment to monetary policy's effectiveness at stimulating the economy. If people could simply refinance at the market rates as they are now, it would be literally, for the average homeowner, thousands of dollars lower payments per year that would just go straight into their pocket. It would be the equivalent of a 30-year permanent tax cut for them of thousands of dollars a year, and that's pretty substantial. Now, you do need to subtract off. Right now, they make a payment to somebody, and that somebody does something with it. So it's not just pure stimulus, but the incidence in the short run of spending the money for people that are massively liquidity constrained and really hurting, trying to figure out how to pay their bills each month, that tends to be higher than for the banks who are currently sitting on reserves and for the mortgage holders. So I think that could have a positive impact.
You know, you said something else that was very interesting. Well, you said a lot that was very interesting, but you talked about this sequestration possibly cutting half to 1% of the growth rate, and Dr. Baskin projected the growth rate at being a certain amount, I think 2% or above. Help me with that. Talk about that, because you know, we had the Democratic Steering Committee policy. We had a policy hearing the other day where Professor Stephen S. Fuller of George Mason University, who's I take it a top economist from what I hear, talked about this very subject, and he believes that even a month of sequestration would be like creating not a hole but a crater in our economy. So I mean, you all seem to, I just want to have your comments.
Okay, I think Professor Baskin and I disagree a little bit on what the multiplier would be of this spending on the economy. If you take forecasters like macro advisors or some of the others, standard macro forecasters, they anticipate that the direct impact of the spending, as Professor Baskin said, is maybe 25 basis points, 2/10 of a point to 3/10 of a point. And the question is, what other spill-on effects does it have? I think that leads it up to be a fair bit higher than the 2 to 3/10 of a point. But I don't think that this is as big, for example, as what the fiscal cliff would have been, which in my opinion would have driven us into a recession. In my view, this will cut the growth rate and will cut it by enough that we drop below the 2%. So actually, there's a decent chance the unemployment rate starts to go back up again instead of starting to come back down. But that's where I would characterize it.
I think Mr. Cummings said it would take quite a stretch to make this into a major macroeconomic event this year. I think it's literally about a quarter of a percentage point direct spending. Economists aren't sure in an expansion with a high debt ratio, with where that spending will be offset, whether the multiplier is slightly negative, 0.6, 1.3. The incoming Obama administration used 1.7 in the midst of a deep recession when all economists agree they'd be much higher. So that would get, if you took that, which I believe is fulsome, but you know, there's a range. There's a range of disagreement among economists. That would get us up maybe to 0.4%. So So even at the most sort of Keynesian of what's been used in Washington recently, it's a minor macroeconomic event. It's not trivial with respect to some particular things. There's a disproportionate to the military. Some people are going to get disrupted. There's no doubt about that. But in terms of the overall hit to the economy, my best judgment, it would be 0.25% or slightly less.
Thank you, Mr. Chairman.
Thank you. Representative Paulson.
Thank you, Mr. Chairman. Well, this is obviously a very extremely important hearing because I do believe our economy has a long way to go to reach its full potential. Mr. Baskin, you had mentioned, Dr. Baskin, you had mentioned that the current recovery is about 10 million jobs short. I agree with you overall that we need a strong, credible commitment to serious fiscal consolidation as well as pro-growth tax reform to turn things around. I'm just really discouraged about even CBO recently announcing that unemployment is expected to remain at about 7.5% all the way through 2014, which would be the 6th consecutive year we've had that type of a situation and the longest period in about 70 years. So I guess my overall worry there is that this is being accepted as the new normal. It's being accepted by Congress, it's being accepted by elected officials, it's even being accepted by employers back in my district that understand that this is what's going to happen now. And I'm worried about that because we clearly do have a growth gap that needs to be addressed. And Dr. Goolsbee mentioned bubbles. And I suppose you can look back at the 80s and see the S&L bubble, the 90s of the dot-com bubble, and some would say a housing bubble and mortgage-backed securities bubble of the 2000s. And now I sort of sense some would argue we're in a federal spending bubble. And let me just ask you this, Dr. Baskin, at our current trajectory of spending right now, at what point do you expect investors would begin to lose confidence in the ability of the United States government to back up our debt,
Mr. Paulson, you're onto something extremely important. Just last week, there was a major paper presented by a former Federal Reserve governor and 3 other distinguished macroeconomists at the Fed, and they concluded that when the debt-GDP ratio, when you look at a variety of historical cases, gets to 80%, and in our net debt, leaving out Social Security, so over the previously accumulated Social Security surplus, whatever we want to make of that, we're a little below that. Our gross debt is well over it. That you run increasing risk of a sudden, abrupt loss of confidence and a dramatic rise in interest rates that requires such a wrenching change in the budget position to become sustainable that you run into these long, depressed growth episodes. That's by former Fed member Rick Mishkin and 3 other prominent macroeconomists. So there's a serious risk. The only honest answer is we can't be sure. But if you're heading toward an iceberg, you ought to change course. You ought not see, well, how close can I get before I make a sharp turn? So it seems to me that we need to start getting the spending curve bending down, and we need to get the debt-GDP ratio not only stabilized, but heading back down to a safety zone, at 50% of GDP or something over the longer term.
Let me ask you this, too, because you just mentioned interest rates and the growing cost of interest rates to the federal government as a part of our budget. As interest rates normalize, at some point they're going to normalize, how much will these payments increase as a part of our national debt? And what are the trade-offs as a larger share of revenues now have to go to actually paying off interest?
Well, that's another important point. I'll let Austin, I don't mean to disrupt Austin's opportunity to answer. I'll turn it to him in a second. CBO projects that the interest costs over the next decade will almost quadruple from somewhat over $200 billion to between $800 and $900 billion a year, both from the higher debt and from higher interest rates. That does not envision one of these abrupt loss of confidence episodes in the meantime, which is possible. It's far from certain, but possible. So the interest payments are going to be crowding out other outlays. They're going to be crowding out other activity. Their higher interest rates will eventually start to crowd out investment, and we need that investment to generate jobs and increases in wages. So it's a serious problem. I think that we've had an unusual period where the Fed, for some good reasons, some not, and I've been very clear that the only grade I can give them so far is an incomplete because we don't know how they're going to exit from this and what's going to happen. I was a fan of their early policies. I thought they've hit diminishing returns and not been a fan lately. But they've basically replaced the credit markets with themselves, basically deciding to keep interest rates close to zero. And that has enabled the budget to look better than it was. That's not why they did it, but as a byproduct, it's been to make the budget look better than it was. So if we kind of normalize the budget for that, looking what it would look like closer to full employment, tax revenues would be well above their historic average of GDP at normal employment, for example, and their spending would come down a little bit on things like unemployment, insurance, and so on. So if we looked at that, interest is going to become a big issue, and of course it's increasingly leaving the country. It's a sizable fraction, roughly half, slightly over half, is now held abroad by foreign central banks and pension funds and insurance companies and so on. So it's a big problem, and that's an extra reason we need to get the debt down. But the effect on interest rates will primarily reflect what the budget position is. And number one, is it a surplus? As Mr. Brady mentioned, a primary surplus if we exclude interest. If we get to a primary balance and a surplus, that should take a lot of pressure off this risk of interest rates rising a lot.
All right, thank you. Representative Delaney?
Thank you, Mr. Chairman. And I want to thank you and the Vice Chair for your opening comments, which, as someone who's new to Congress, I found is overly constructive and bipartisan, and I appreciate that very much. Thank you for having me on the committee. Dr. Baskin, I thought the last point you made was actually a very good point, because I think the point that's often overlooked when we talk about our deficit situation is the fact that we don't borrow from ourselves. Other countries like Japan that have been able to maintain very high debts effectively borrow from themselves, and they don't have market forces that affect their interest rates. In other words, it's not just controlled by ourselves, which is really why it's so important for us to deal with this now while interest rates are low and while we have the flexibility to reform some of our entitlement programs in a smarter way than what will ultimately or inevitably happen if we don't deal with this now. So I agree with the comments. But I wanted to actually shift my question to tie into some of the comments that actually Mr. Hanna made, which I thought was a very good point about U.S. competitiveness. Because it seems to me that that's one of the central issues that this country faces. And it really started probably 20 or 30 years ago when we entered a global and technology-enabled world, which really did change the face of employment in this country. And while we talk a lot about tax policy, we talk a lot about the size of government, I worry that we don't talk enough about what the future competitive situation of this country is, because even though we've seen cyclical employment trends, the trends around the standard of living of the average American have been very consistent. They've been down. And that seems to me to correlate directly to our competitiveness, because if you're competitive, you actually create jobs that have a decent standard of living. And if you're not competitive, you continue to create jobs, to the extent you create them, that have a deteriorating standard of living. And when I think about our competitive situation, it seems to me reforming immigration. You know, there's 7 billion people in the world. 6 billion still wake up and largely want to come here. It's a huge advantage we have as a country. Having a national energy policy, or the lack of a national energy policy, which we don't seem to have as a country. Not doing the things in education. There's never been a stronger correlation than there is now between having a good education and getting a job. Not investing in our infrastructure, and not creating enough avenues for the significant amount of private capital that is accumulating to actually invest in our economy and shoulder some of the burden that government has effectively had to shoulder. I worry about these things as it relates to our long-term competitiveness. And my question to you two gentlemen, and field it as you see fit, is how do we think about the role of government in light of what I think is a changing economic landscape for the country? In other words, a landscape that is defined by globalization and technology. How do we think about the role of government to address these things to make us more competitive? So that we actually can reverse the employment trends. And again, the employment trend I'm most concerned about is what's happened to the standard of living of the average American.
You want to start? I've had the last few, but I'll be happy to go.
My grandmother lived in Waco, Texas, and she used to say to me whenever I complain about anything, she'd say, you know, 80% of the world really doesn't care about your problems, and the other 20% are glad. And if you were thinking, how long will we need to wait before the government solves our private sector competitiveness problem? I think the answer is forever. The government isn't going to. If you were waiting for the Fed to fix it or the government to fix it or anyone else, you'd do best to remember that the vast majority of what happens for the competitiveness of U.S. enterprises has nothing to do with the government. Policy is only setting the framework that's operating in. in my view, the government has, for many decades, played an important function through direct and indirect support of research, development, innovation in ways that have been quite fundamental to the growth of U.S. industries. The economic infrastructure of the country is quite important. You can disagree about individual job training programs, but there is not any question in my mind that overall federal support through financial aid and through training have been crucial in keeping the workforce the most productive in the world. And we do also need to have things like a national energy policy. The potential drop of energy costs could be a great boon to U.S. manufacturing. So it behooves us to figure out a way to take advantage of the new discoveries while being mindful that we've got to do that in a way that is safe. But I think that it is in those types of broad-based things that the government can play a more important role rather than in the directly making companies more competitive.
Yeah, I think Austin and I generically agree that this is primarily something that the private sector primarily does this. The government plays a supporting role and directly does a few things we wouldn't expect the private economy to be able to do well. Pre-competitive research and development, that's, take the extreme case, basic physics, individual firms can't appropriate the benefits from that, so they're not going to do it, so it has to get done through NSF and things of that sort. But that needs to stop short of outright industrial policy where we're subsidizing specific firms, by the way, which means you're getting a competitive advantage for their disadvantage for the competitors. Education is important. The key, however, is the key difference between Austin and I would suspect, is we would draw the line. I would draw the line a little shorter than he would. He would have a little larger government. I would be very concerned about the effectiveness. He was sure he'd be concerned about the effectiveness, but I'd be concerned as the larger it got, the less effective it got. And importantly, as the government's playing this role, the larger it gets, it does crowd out the private sector. So if a combined federal and state and local government that's 50% of GDP versus 40% versus 30%, the larger it gets, the less, on balance, the more difficult time the rest of the economy will have, because it's got to pay taxes and do other things to support that size of the government, which provide disincentives to work and save and invest and innovate.
Thank you,
So
Dr. Baskin. I don't mean to interrupt. With votes pending, I want to make sure we get as many people as possible. Senator Coates?
Thank you, Mr. Chairman. I asked my staff excuse me. Thank you, Mr. Chairman. I asked my staff each day to prioritize my memos, and I'm going to work off this first one. Despite Tuesday's loss at Minnesota, the Hoosiers still control their own.
Thank you for bringing up that fact,
Yeah,
Senator Coates. We appreciate that.
That's my first priority.
Since they lost to our team.
Let me get to my second priority.
I never thought I'd be from a football powerhouse either.
The Cubs still stink.
As a lifetime long-suffering Cubs fan, that's an area where Dr. Goolsbee and I have suffered greatly. Let me get to my questions. Dr. Baskin, I was interested in your comment here, which I'd like to go in a little more detail. I'd like to get Dr. Goolsbee's response to this. You said economically balanced is not 50-50 between spending and taxes. Simpson Bowles came in with a commission report of a 3-to-1 ratio, spending over taxes, yet the administration continues to insist that any kind of long-term deal ultimately that will put us on the right track has to be 50-50. What should that ratio be? And you said it shouldn't be 50-50. What do you think it should be? And Dr. Goolsbee, how would you respond to that?
Well, I think the economic evidence from looking at all the fiscal consolidations in the entire OECD since World War II would suggest that the successful ones have been $5 or $6 of actual spending cuts, not hypothetical future ones, but actual cuts that occurred for every dollar of tax increases. That doesn't mean that it has to be exactly that. It could be a bit smaller, a bit larger. The U.S. may have slightly different circumstances, but it suggests it's primarily on the spending side. The evidence also from economics research suggests that tax hikes are much more likely to cause recessions than spending cuts. There are many studies that suggest that. There's a study by one of Austin's colleagues when he first joined the Council of Economic Advisors, suggesting that what they would call the output multiplier is very high for tax increases. So tax increases can be very dangerous in the short term. So I think that the mix, for economic reasons, there are many other considerations. People care about the size of government as a political and philosophical and liberty issue. People care about the distribution of income and so on. But basically, as a macroeconomic issue, it should be overwhelmingly on the spending side, in the vicinity of 5 to 1.
Dr. Goolsbee?
I think two things on this. First, the evidence that Professor Baskin is citing is based on a circumstance that's fundamentally different than the circumstance we're facing now. Our long-run fiscal challenge is nothing more and nothing less than the population is aging and the healthcare costs are rising, so that if you just advance forward the baby boom to their retirement with the existing policy that we've known about for 40 years, it implies the government's size will get bigger than it ever was before. And so either you've got to cut those promises or you've got to raise revenues higher than they've ever been before to cover them, or some balance. Those are fundamentally different than the experiments that are in this evidence. In my view, Simpson-Bowles laid out what they said is 3 to 1, but that's counting saved interest payments. It's really about a 2 to 1 ratio. When the administration is arguing about 50-50, I think it's best to also remember we've had one round that was all cuts and no revenue, and then one round that was all revenue and no cuts. If you add all of these things together, so far we're at about the 2 to 3 to 1 ratio that was in Simpson-Bowles. That strikes me as a perfectly appropriate starting point that we ought to balance these things against. So not on any one particular deal, but at the end of the day, if we do the $4.5 trillion of cuts over 10 years that Simpson-Bowles recommend, that the total would be 2 to 1 or 3 to 1 spending cuts to tax revenue seems totally appropriate.
I've got 35 seconds. Dr. Baskin, any follow-up to that?
Yeah, I think it's important to appreciate two things. Number one, this is not primarily an aging of the population problem. The projected cost increase in Social Security and Medicare are primarily because of rising real benefits per beneficiary. Demography is a very large minority partner, but we're making them more and more generous as they go along relative to the cost of living. Now, some people might say we ought to have those be proportionate to the size of the economy, but the original mission of Social Security, in FDR's words, was to provide a measure of security against poverty-ridden old age. If I were to collect Social Security at the right time, I'd be getting twice the poverty level just in my Social Security payments. So we can't keep projecting. I would use projecting, not promises. I don't view 70 years from now as a promise. Ask my students or young children today, they think that Social Security won't be there. So it's a big increase if you actually provide something for them, not a cut. So I think that we have to get these programs under control. With respect to the Simpson-Bowles, I think there were many good things in there. I supported a large fraction of them. They didn't deal with health care costs seriously, and that's a big issue, and that is a large, as the President and others have said, a large driver of the future debt.
Thank you, Mr. Chairman.
Thank you, Senator. Representative Maloney?
Thank you, Mr. Chairman. I'd like to commend you and compliment you on your new position, and Vice Chair Senator Klobuchar. I also would like very much to welcome a new member on the Democratic side, Mr. Delaney from the great state of Maryland, who has been a very successful businessman and will bring a tremendously important perspective to this committee. And of course, I welcome our two panelists and thank you for your government service for our country. Tomorrow, the real question before our government now is sequestration that kicks in with an $85 billion cut. It is estimated that this will result in a loss of over 700,000 jobs. Chairman Bernanke testified yesterday before the Financial Services Committee in the House of Representatives. And although we have been gaining jobs over 35 months, roughly 6.1 million in the private sector, 5.5 million of non-farm payrolls, but the government lost 0.6 million jobs. But he testified that the sequestration was a problem not only, and I'll quote for him, besides having an adverse effect on jobs and incomes, But he said a slower recovery, which he says sequestration will cause with our fragile economy, would lead to less actual deficit reduction. Now, the whole purpose of sequestration is deficit reduction. He's testifying that it will slow that because of the impact on jobs and incomes. There's been testimony today that the impact on GDP would be roughly a quarter of a percentage point, but the independent CBO estimates that it will contribute about 0.6 percentage point to a fiscal drag on the economic growth this year. And I'd like to hear your comments in relation to what Chairman Bernanke was saying, that the idea of phasing it in over time, having targeted reductions. The Democratic minority keeps putting forward closing loopholes. Let's not fire all these people that are paying their taxes, a part of the economy, dredging more money back into the economy instead of having them on welfare and not able to produce and be part of the economy. And this is turned down by the Republicans. But there was an article this week in one of the papers where Speaker Boehner was quoted as saying, in terms of the tax debate, because we all support tax restructuring, that he would take closing loopholes if given a lower rate for taxes. But it seems to me that closing some of these tax loopholes, why we are giving tax breaks to companies that move overseas and take our jobs over there, is beside me. If you're going to give a tax break, give it to someone who's providing a job here in America. Also, the tax subsidies of 40% in some examples to really very successful oil companies that are making a lot of money. Why are we subsidizing a company that's making a lot of money? It seems to me that closing these loopholes and lowering the deficit would be a better approach than closing loopholes and giving a lower tax break. So I'd like Mr. Goolsbee's response to those two questions, and yours, Dr. Baskin, too.
Okay, on the first, I think I'm more in the camp, as I outlined, of the Congressional Budget Office and the macro advisors, that the impact of sequestration would be half a point to as much as a full point off the growth rate. And that I think that would be enough to set the labor market back and might even just start deteriorating. On the tax loophole point, I think what Professor Baskin said in his testimony, that there is a whole lot of spending that is done through the tax code, is correct. And so if you cut the loopholes, it is not accurate to think of that as tax increases. By that very logic, we should be viewing cutting of tax loopholes as spending cuts. So I don't see that there's any problem with changing the form of the spending cuts to be in a more rational direction, and I hope that we would get it off of the next 6 to 12 months and into a period where the economy would be recovering more quickly.
Gentlemen, I'm going to be tight on the 5-minute limit for questions just because votes have been called. And so I'd like, with your permission, to be able to do Representative Campbell, Representative Duffy, and Senator Lee in that order. Representative Campbell?
All right, thank you. And because votes have called, I won't take the full 5 minutes. So I'll just ask one question. The title of this hearing is, why have economic growth and job creation remain weak, and what should Congress do to boost them? I would ask each of you, and I'll start with Dr. Baskin. This House and the Senate, we can't do too many things at once. It's just kind of the way we are. So give me your number one thing that you would think we should do to boost job creation and economic growth, and one thing you would say we should avoid. Dr. Baskin.
The thing I would avoid would be any major tax increase. The first thing I would do would be to try to have a credible commitment to serious fiscal consolidation as the economy phased in. That would mean changing indexing formulas, altering structural features of programs, not just cutting a few billion off of one program next year that could be reversed the next.
Fiscal consolidation, that's a new word.
Primarily getting spending headed down as the economy recovers.
Okay.
Growth of spending heading down, the spending GDP ratio heading down.
All right, Dr. Goolsbee.
I guess I would say putting investment in the workforce is the most important thing in the short run. And I'd say the thing to avoid would be anything that's going to have a significant negative impact on incomes and well-being of the broad middle class of the country over the next 6 to 12 months.
Okay, both those are pretty broad. Investment in training, you said? What
Sure,
is that?
quite specifically, federal R&D spending, I think that we should not just not cut it, that we should increase it. I think investments in economically important infrastructure, which are not all roads and bridges, I think, but a lot of the shipping, container ports, and that type of infrastructure is important.
Okay, and then the thing you said we should avoid was what? Give me an
Anything that
example
has
of that.
Well, tax increases on the middle class would be one.
Okay.
Things that are depressing the wages of the middle class, or I'll leave it at the biggest example would be things that would increase the taxes on the middle class. But the stuff that we're doing on the housing front can be thought of in someone in that vein.
Thank you very much. And, Mr. Chairman, I'll yield back so others have a chance.
Thank you, Mr. Campbell. Representative Duffy?
Thank you. I'm concerned about the unemployment rate of our youth. I believe the number from those who are 16 to 19 years old have an unemployment rate of 23.5%. Those who are 20 to 24 years old have an unemployment rate of 14%, much higher than the national average. I would ask you both, and with some quick answers, are you concerned about it? And what impact does that high unemployment rate have on the life skills that our kids learn at this very important age?
Well, you're exactly right. It's a major, even though it's limited to some subset of that group, it's a major problem. Not being in the workforce means they're not acquiring those skills, so they're relatively being left behind.
Yeah.
What skills they've learned in high school or from part-time jobs or jobs earlier is deteriorating. So I think it's very important that we have a more robust economy. We've talked, we agree on some things, disagree on others about how to create that in the short run. But I also think we need to dramatically improve our K through 12 education system. I think injecting competition into it is one. It's not the only, but it's one thing that could be done to improve it, so that they wind up at the beginning of their careers with skills that are better matched. And number one, and number two, we reform these programs that we spend a lot of money on, so that they actually provide jobs, not just spend a lot of money.
Right. Thank you. Mr. Goolsbee?
Sadly, and I've published on the subject that I'm about to describe some work, the evidence suggests that the negative dynamic you're describing is persistent and damaging. That if you come out of school in a period which it's hard to get a job, or you're forced to take a lower level job than you should based on your background, that sticks with you, partly because of less skill development, partly because you get tracked in a negative way. So I think it's critically important. I think the most important way to do that is to get the overall growth rate of the economy up. But I think that the youth unemployment is one of the weakest and scariest parts of the labor market.
And that age range from 16 to 19, 20 to 24, are they the higher earners or the lower earners in our economy? They'd be the lower earners, right?
Well, yes and no. It depends where you are in the skill distribution. I was going to say, so for the 16 to 19, you have seen actually a big uptick as people couldn't get jobs to stay in school longer.
But you'd agree that on average, our younger individuals make less money.
Oh, yeah,
So, right.
sure.
So if we want to improve the opportunity for the youth in our country to make sure they learn the skills that are necessary to be successful on a career track, can we grow more opportunity for them, create more jobs for them, if we would just raise the minimum wage?
No, I think that the minimum wage has offsetting effects. It may raise the incomes of some, but it obviously will disemploy others. And it will tend to disemploy people with the lowest skills. It's not very carefully targeted in this regard, so teenage children of rich people who are working in minimum wage jobs will get more, et cetera. So it's a big concern, but I think that that raising the minimum wage is not the most effective way to try to deal with this problem.
And Mr. Goolsbee, you had talked about the growth of jobs. Will that help grow jobs if we raise the minimum wage for that sector of our economy?
Well, I think the most important word in what Professor Baskin just said is the trade-off, that the minimum wage has trade-offs. That there are some people that it would raise their wage and make it harder to get a job. There are others it would raise their income. And the question and the trade-off is really, how much do you think that affects the overall income and consuming power?
My question is very specific, though. Will it grow jobs for the?
It could. It depends, as I just said. If you believe that the total income is going to rise for low and middle income people, then that could grow jobs, yes, by
so your position is that
increasing purchasing power.
If we increase minimum wage, that means that more of our small businesses or manufacturers, the places that a lot of these youth work in, will have more opportunity and more jobs for the youth in our community? Is that your position, Mr.
Well,
Goolsbee?
no, Mr. Congressman, my position is that the minimum wage does several things, not just one thing. And so just looking at the one thing is the incorrect way to look at it.
But I am looking at the one thing with regard to job growth and your position.
As regards to job growth, there are two factors. One is, what is the direct impact on the wage of the people who can't get a job? On the people who are still employed, their income goes up. And what's the overall macro impact? And the macro impact may outweigh the direct impact.
So to invest in our workforce and to grow jobs, a good policy would be to increase the minimum wage to provide more opportunity for the youth in our community.
Look, it could or it might not. It depends on what those values are.
Whatever you
We'll be tied, if you don't mind, and we can continue this discussion. Thank you, Mr. Duffy. As I recognize Senator Lee, let me let you know votes have started in the House and the series has. I want to thank Dr. Goolsbee and Dr. Baskin for being here today. Very helpful. And as Senator Lee closes out discussion, I want to turn the rest of the hearing over to the Vice Chairman. And thank you very much.
Thank you very much, Mr. Chair. We had great attendance at this first hearing of the year, and I thank you for your leadership.
Thank you, Chairman, and thanks to both of you for joining us today. Dr. Baskin, I wanted to talk to you a little bit about tax reform. There does seem to be a pretty broad bipartisan consensus that that we need some kind of tax reform, especially some kind of tax code simplification. It was in this committee just a few months ago that we had a gentleman who has a PhD in the U.S. tax code system, and we asked him if he did his own taxes, and he said no. I don't, and we asked why, and he said because there is no way I could possibly know whether I was correct. And I think that's indicative of how many Americans feel. So for that and other reasons, I think there's a pretty broad consensus among Republicans and Democrats in both houses of Congress that a simplified approach to the tax code would be better. We need some kind of tax reform. There is not broad bipartisan consensus on what that ought to look like, at least in the sense that some are less inclined than others to say that we need a tax reform package that would yield more revenue when statically scored. But I think most would agree that as long as we're within the world of saying if we're statically scoring something, if we can assume that we're going to be neutral if we keep what we've got, maybe we would be better off reforming the tax code, simplifying it, and leaving it revenue neutral, at least under a statically scored model. And then at that point, some would suggest that that would stimulate economic growth, leaving us free then to see whether or to what extent it did lead to more revenue as a result of economic growth occurring in the wake of passage of that reform package. Would you tend to agree that that would be a good idea?
Yes, I think it's an excellent idea as long as it's primarily of broadening the base and lowering the rates. I think that a tax reform that raised tax rates would be a bad tax reform. So broadening the base and lowering rates. We haven't talked much about corporate tax reform or about small business here, but so many successful small businesses, 3% of the businesses, but half of small business income, some of it's passed through, but some of it's what we normally think of as small business, pay on the personal form. So broader base, lower rates would be very good for their incentives. And we have the highest corporate rate in the world, nominally between federal and state taxes, about 39%, the highest in the OECD. The effective rate, when you account for deductions and exemptions and so on, is lower. It's in the high 20s, but it's out of line, but not as far out of line as the statutory rate. So I think that moving in this direction could be very good for the economy in both the short and long run. But and I do believe that if it was accurately statically scored, that at least over time, it would raise more revenue than is likely being forecast in the models.
Particularly if, as you suggest, we lower the rates and we broaden the base. Would that also tend to have the impact of stabilizing and producing a less volatile revenue stream? You know, it's my understanding our income tax system brings in about 18.5% of GDP on average. We have peaks and valleys within that. I think in 2011 we were in a valley of about 14.5%. At times we've gone just a little over 20%, but generally don't go higher than that. Could lowering the rates and broadening the base produce a more stable code?
It very much would, because the steep progression, some say the rates are too high. I'm not going to argue about the levels, but we have, relative to the other OECD countries, according to the OECD, the most progressive tax system. They have larger tax, they collect more with value-added taxes, but we have a more progressive tax system. It becomes more volatile. The place to see it most is my home state of California, where we have by far the most volatile. We have a very progressive income tax, and we get into this awkward situation, especially with our balanced budget requirements, which are sort of adhered to. We wind up having the revenues flow in, they spend that, they project more, then the crisis hits, we rely heavily on capital gains and stock options across the Silicon Valley, the revenues collapse, it's very hard to cut spending, so we wind up trying to make the tax code more and more progressive, and we wind up not being able to even fund the basic benefits for people that are really hurting in California.
Tough cycle.
So you're right.
That is a tough cycle. So yeah, that's why I ultimately tend to come to the conclusion that where there's not consensus on everything, we ought to look where there is consensus. There does seem to be a certain amount of political consensus that we need tax reform in the form of simplification. Maybe we could start out with something revenue neutral when it's statically scored, and then see where it takes us. That would leave subsequent Congresses free to either plus up or minus down where they go from there. If I can ask one more question, as my time's expiring.
Of course,
Madam
it looks
Chair.
like it's just the two of us here,
Thank you.
Senator Lee.
Thank you.
So
I appreciate that.
Please go ahead.
Thank you, Madam Chair. In your testimony, Dr. Baskin, you mentioned the need for permanent structural changes, not just a specific dollar cut, while discussing a credible commitment to deficit reduction. Can you speak to us briefly on the importance of maintaining our nation's credibility in deficit reduction packages, and why it is that markets are not going to be satisfied in this regard with cuts? In other words, tell us why cuts just won't cut it anymore. Well,
It turns out that if you look at the history of these budget negotiations, I've been involved in several when I was CEA chair, for example, and advised on others. Sometimes the cuts, quote cuts, unquote, evaporate later. Now, sometimes tax policies change also later. That tends to happen less frequently. A lot of frequent changes, but the tax, if you cut tax rates, it becomes a much bigger battle than small changes in spending at the next appropriations hearing. So I think what people want to see in financial markets, what people want to see about what the environment's going to be for investments that are paying off 5 and 7 and 10 years. Now, Austin mentioned infrastructure. A lot of that should be going on in the private sector. Big investments in, he mentioned energy. We can be exporting natural gas. That's going to require firms investing $10 billion for an export terminal. To do that, they have to have some notion of what the taxes they're going to pay on that are when they finally get that investment done and they're starting to export the stuff. And so that's to me, credible means that the rules have changed and they're harder to reverse than just a typical single appropriations bill next year if the makeup of Congress changes and so on. So tax rules, indexing formula, retirement ages phased in over time, things of that sort. We've had a history in the past of those actually occurring, like from the '83 Greenspan Commission, Social Security changes.
These are the kinds of permanent structural reforms you're referring to as contrasted against something that just occurs in a CR or something.
Yeah, you just say we'll cut $10 billion, and it may happen once or it may not, and the following year it's up for debate again.
Thank you, Dr. Baskin. Thank you, Madam Chair.
Thank you very much, Senator Lee. I just had one last question as we grapple with immigration reform in the Congress. And if you could just talk, each of you, a little bit how you view this from an economic viewpoint for the country. There's many aspects of immigration reform, but one of the parts that I've been working on with Senator Hatch and I have a bill called I Squared, along with Senator Rubio and Senator Coons. And what it does is basically makes it easier for students from other countries when they study at our universities that they more easily access a green card, in fact, get a green card when they get an advanced degree in science, math, technology. And then we also are doing more with the cap on the H-1B visas. Senator Warner and Senator Moran have another bill called Startup 3.0, I think, that is about entrepreneurial visas. And if you could talk a little bit about how this fits in with the overall economy. We've been focusing on job training, which is a major part of this. In fact, our bill adds $1,000 in fees. It's supported by the Chamber for each of these H-1B visas, and that money is going to go directly to STEM education to help train our students in these areas where we have openings right now. I guess we'll start with you, Dr. Baskin, and then end with Dr.
I'm a strong advocate of immigration reform, sensible immigration reform, and three key components of that would be the green card provision you're talking about. It's silly that we have these great students that come from abroad to Stanford and Chicago and the University of Minnesota, and then we send them home. We make it hard for them to stay. They should be working here and helping us grow our economy. The H-1B visas, again, we tend to focus a lot on the problems of people who are at the lower end of the income scale, as we should. That's a big concern, but we shouldn't neglect the technology jobs and so on. Those are important. That's a place where the economy is growing and can continue to grow. And then thirdly, of course, we need a sensible guest worker program. There are other aspects about making sure that we do have a border that's enforced and things of that sort, and these get very emotional, but I think it is the case that we have been refreshed numerous times by waves of immigration in our society. One of the beautiful things about America is how diverse we are in many dimensions. And it seems to me if we're smart and we have an immigration policy that strengthens the opportunity for higher skilled people to stay here and improves the opportunities for people with lower skills, that it could do so again. Also, finally, I would say these problems of Social Security and Medicare and the slowing growth of the labor force, which Chairman Brady mentioned about potential GDP, out there over the next 50 years, unless our birth rates change, we're going to probably need to have some more immigration.
Mm-hmm. And I appreciate those comments. And one of my favorite statistics is that 30% of U.S. Nobel laureates were born in other countries. So, you go back in time, and this has been a major part of our innovation in our country that's built America. Dr. Goolsbee?
Look, Senator, thank you for your support and leadership on this issue. We talked about this a lot when I was in the administration, and we should keep talking about it now until such time as we change it. The President has endorsed that. I championed the several of the ideas that you mentioned, startup visas and the green card type policies when I was in the administration. And I think you don't have to look very far, either in the research literature or just talking to business people, to recognize that immigrants have made not just an important contribution to the legacy of who we are as a nation, but to the economy. My friend John Doerr said that 50% of the companies that Kleiner Perkins has funded have at least one founder born outside the United States. And I think on net, they're big job creators, and that by doing some of these things that we could have a positive impact. I think on H-1B visas, they do have the complication that you're tied to one employer, so I know there are some issues.
We actually have made some changes.
So making changes on that, I think, is a good idea, as well as expanding the number.
Okay, very good. Well, I wanted to thank both of you, first for your knowledge and wisdom and everything you shared with us, but secondly, the civility that you set here, I think bodes well for the future of this committee. I had several members say, this is so unique. Everyone's acting. So I hope that we see more of that going forward. I think we all know we have to come together to solve these challenges. The American people are demanding it, and I thank you for setting a good beginning for this committee, one that you've testified before, it sounds like, for 30 years, Dr. Baskin. So you've seen it all, probably many different outfits and hairstyles over the years. But we are very excited. Chairman Brady and I are going to do a number of hearings, obviously, on these topics and move forward. But thank you very much for being here, and the hearing is adjourned.
You're welcome.